Hey there, John Strohmeyer with Strohmeyer Law in Houston, Texas. Today, we're talking about the provisions and the new ideas that are coming out from the House Ways and Means Committee. There was a new proposal released earlier this week on September 13th that have some estate and income tax implications for folks. So we're going to take a minute. We're going to go through it. Here's the top line. Right now, these are proposals. These are not law. This hasn't even made it out of committee, so we don't know how much will make it through the grinder to get out of the House, then get through the Senate, and then ultimately on to Biden's desk to be signed. Now, we'll take this as right now we don't know. Some of these are likely to come into law. Some of these we probably knew were coming anyway. There are some things in here that are a bit of a surprise. There are some things in here that really aren't that surprising at all. So we're going to go through it. I'm going to go ahead and share my screen. What we're going to do is we're going to work through the responsibility for funding our priorities page. And I'm going to go ahead and drop this link in the chat for anybody following along. If you want a link, you can go get this document and read along with me. For those of you on Instagram, if you want to do a search for the responsibility for funding our priorities on a page, it's up there. Unfortunately, I just can't get the link into Instagram. Part number one, well, we're going to increase the corporate tax rate. Well, we're going to go up from an 18% rate on the first $400,000 of income. It's going to be 21% on income up to $5 million, and then 26.5% on everything after $5 million. So this is going to pick up and actually increase the tax rate. The benefit of this graduated rate is going to phase out for corporations making more than 10 million. What this really means, well, we'd already had pretty much a phase out of graduated rates. Basically, this is a corporate income tax rate. There are going to be obviously some limitations on personal service corporations, but for right now, there's not much else we can do about this. Again, this really isn't much of a surprise. I'm going to skip the international provisions. Really, for most folks, the international stuff is not what you're looking at, but we do want to think about that for some of our foreigners who are either working here in the U.S. or we've got U.S. persons working abroad. For what we do, I have not seen any provisions that really affect U.S. persons investing abroad directly as in a way that doesn't affect the corporate taxpayers. The things I'd look at for international would be changing how estate and gift taxes work. That wasn't going to come for international provisions here. And for non-U.S. persons, if their exemption amounts changed. Again, I don't expect that really to change much. Right now, the exemption amount for non-resident, non-domiciliaries remains $60,000. I don't see that changing anytime soon. They just don't have a big voting block in Congress. And so for right now, they're just not a priority. Skipping down, we're going to kind of go past the business tax to really focus on the estate and gift tax issues. So obviously we're flying on past a number of things here. When I get to part two, tax increases for high income individuals. First off, section 138201, increase in the top marginal individual income tax rate. Well, here we are rolling back tax rate decreases that Trump brought you. Provision is going to increase the top marginal income tax rate back to 39.6%. So this is going to apply to individuals filing jointly with taxable income over $450,000, as well as heads of household with taxable income over $425,000, and unmarried individuals with income over $400,000. So again, what we're looking at is basically we're raising the top marginal rate. This is in line with what Biden had promised. Here is the promise from campaign of not raising taxes on those making less than $400,000. This is how he's going to say he complied with that. Now, we're going to get into things that could obviously pick up taxable issues for folks who make less than $400,000 a year. We're going to be talking about things where we can come into taxation on estate and gift tax issues where it's not tied to your income. But this is going to be the part where, here, raising top marginal income tax rate, that's what Biden said he was going to do. But he's also not raising that tax rate directly on people making less than $400,000. Again, next, increasing capital gains tax rate for certain high income individuals. So this is going to increase the capital gains rate up to 25%. This is going to apply, it looks like, after for tax years after the introduction of this act. And so the pre-existing 20% rate will continue to apply to gains and losses for the portion of the year before the date of introduction. What they're doing here, this is where retroactivity comes in. When people say we're worried about retroactivity, generally it's capital gains. What they don't want to do is have a run on the market because of this tax bill. People get worried about this for estate and gift tax issues. I don't think we're not going to see it for a lot of things here. So gains later recognized in the same taxable years before the date of introduction, pursuant to a written binding contract, are treated as occurring before the date of introduction. Again, they're trying to limit the kind of economic fallout that can happen from a bill just like this. Application of net investment income tax, or the NIT tax, to trade or business income, certain high income individuals. So sticking with that campaign promise of $400,000 for single filers and $500 for joints. This is going to amend the net investment income tax to expand its application to cover net investment income tax in the ordinary course of a trade or business. So this is clarifying it's not on wages, which is covered by normal excise taxes, Medicaid, Social Security taxes. This is going to start next year. So any year that begins after the end of this year. Obviously, starting in tax year 22. Limitation on deduction of qualified business income for certain high individual filers. So 199, which was added by during the Trump administration, it's going to cap the maximum allowable deduction in the case of a joint return. So this is a new provision, again, limiting how much of a deduction you can take on that. Excess business losses, it's going to permanently disallow excess business losses. So net business deductions over business income for non-corporate taxpayers. Corporate taxpayers, they play by different tax rules for a lot of reasons. It's not all just lining things up for corporate taxpayers, but this is meant to limit how much an individual can take as non-business losses or excess business losses. This would kick in starting for tax year 2022. New surcharge on high-income individuals, trusts, and estates. So this is going to be basically a new surtax. It's going to be 3% of their modified AGI, or adjusted gross income, over $5 million. So basically, we talked about the new tax where we're raising rates up to 39.6. It looks like they're going to add this, bump it up to 42.6 if you have income over 5 million, or in excess of $2.5 million for a married individual who files separately. Just remember, married filing jointly is a status you have to elect into. If you are married filing, if you're married, the default is married filing separately. You have to elect to file jointly with your spouse. Again, who knows how this is actually going to look and what there might else be in there, but modified AGI means adjusted gross income reduced by any of the normal deductions allowed for investment interest. Big one for estate planning. Here we go. Temporary, or the termination of the temporary increase in the unified credit. Now, this is the thing we've been talking to clients about before and for many years. I've been saying we don't want to treat the exemption amount as 11.7 from now until infinity. It's $10 million adjusted for inflation from 2011. That puts it at $11.7 million per person for both as a unified credit between estate tax and gift tax. It goes up for inflation every year. In 2026, according to current law, it's going to drop and it's going to be $5 million adjusted for inflation. Well, what this is doing is it's saying that temporary increase is going away. We're going to just revert to the 2010 level of 5 million and then index it for inflation, which means it's going to drop from 11.7 million here in 2021. They don't say it in here, but apparently this is going to take effect in 2022. So you'd have the rest of the year, according to the current proposals, to take advantage of this extra exemption. What does that mean? 11.7 million, you're going to go down to probably 5.8, 5.9 next year if this passes. That's a loss of $5 million. The thing I'd be thinking about with this for clients, if you were thinking about making larger gifts, this is the time to start accelerating that. We're going to want to move assets out of your estate. We're going to take some assets out. We're going to try and burn through that credit. What we don't know, but what I'm going to guess about is how does this affect the amount of credit you have left? My guess is that they're going to say, look, if you burn it down, if you burn down $1 million of credit, well, if you had 5.9 next year under this new law, well, you will have used up $1 million of that credit. If you make gifts of $2 million this year, you're going to end up using $2 million off of what you have next year. So instead of 5.9, you'd have 3.9. The benefit of the extra exemption right now is generally seen as if you make more than what you're about to lose. So if we're going to go from 11.7, and I'm doing some math so I can get this right, hopefully, down to 5.9. That's about 5.8 million in exemption. So if you've got 12 million and you make gifts of about, well, let's just call it 7 million, you're going to burn through everything. You would actually be net zero. The way this is intended, and we think everything's going to end up working out, is that you won't owe tax for being over January 1, 2022. But, basically you'll be in the hole. You won't have any unified credit left to give away. We're still talking about $5.8, $5.9 million per person. This is a lot of exemption. Again, this is what I've been telling clients for the last few years. Don't treat the 11.7 as permanent. It's going to come down. What we haven't seen, this was not Bernie's dream of bringing it down to 3 or 3.5 million. What we also don't see is that this is effective immediately. It's not retroactive. Heck, even Bernie's proposal from January of this year was not retroactive. So retroactive estate and state tax reductions, it's just not something we've seen. It's not something to think about. Mostly there's enough time for them to come and get those assets. They're not going to play that game. They'd rather just get the exemption lowered. $5.9 million is still a lot of money that's exempt. Other notes that I had. So again, we're accelerating this. And so those transfer tax exemptions, basically, we're going to lose a lot of it. The upside is if you were thinking about using this exemption, the real reason to start thinking about this is you wanted to make gifts well over that exemption amount, basically more than what you'd be losing. This is the time to do it. If you're going to make any other gifting, now is the time to do it. We're probably going to start seeing more of this. All right. Who would have known one little sentence could get me to talk for, I don't know, we'll call that 10 minutes. Increasing the limitation, so section 138.208, increase in limitation of estate tax valuation reduction for certain real property used in farming or other trades or business. So we're going to end up amending section 2032A to increase the special valuation reduction available for qualified real property used in family farms or family business. So this reduction allows decedents who own real property used in a farm or business to value the property for estate tax purposes based on actual use rather than fair market value. Now, it's going to increase the allowable reduction from $750,000 up to $11.7 million. So this is really meant, for the people who are saying, oh, well, you're going to take family farms. I have never, the family farm generally, in my experience, is not up for is not on the block when we're paying estate tax. There's usually liquidity there. What this is doing is saying, look, if you think we're going to come take it because of the 11.7 is going down to 6, they're addressing that threat. They're keeping it 11.7 to allow folks to really use this adjustment in value, and this is what the political side of it is for. They're addressing that. So next, 138.209, certain tax rules applicable to grantor trusts. Now there is a lot in here. Grantor trusts are a big deal for estate planners. What we are thinking about when we are dealing with grantor trusts, these are trusts which are normally taxed as separate entities for tax purposes from the people who create them. So you've got a separate taxpayer. They pay tax at higher rates, meaning they hit the top income tax bracket at about $13,000 of income instead of $450,000 worth of income. One of the planning options we have is, instead of having that trust taxed as a separate taxpayer, it's taxed as a grantor trust. When it's a grantor trust, it means the person who is treated as the grantor, usually it's the person who set up that trust, that person is taxed on everything that is generated as income inside the trust. Okay, why do we do this? When the grantor pays the income tax for the trust is growing free of income tax. What I didn't say was there is no income tax paid. No, the grantor is paying their tax at their tax rate. Generally, this means they're paying still at the top income tax bracket. We're shifting from a trust that would have paid at the top tax bracket to an individual who probably is also going to be paying at the top income tax bracket. We're shifting who pays it. The benefit of this sort of planning is that the assets inside the trust grow effectively income tax free while the grantor is still alive. Once the grantor passes, the trust becomes subject to tax on its own basis as its own separate taxpayer. So this is really a lifetime only planning technique. So what are we looking at? Well, we're going to add new section 2901, which pulls grantor trusts into the decedent's taxable estate if the decedent is the deemed owner of the trust. This is a big shift because normally we could kind of pick how we want the trusts to work. You would gift assets into the trust, and once they're in the trust, you can have them be treated as a completed gift, draw down your exemption amount, and then those assets are not subject to future estate tax because you've used your assets, you've already gifted them out, but then they're going to be now subject to income tax. But now we're saying, look, if you're taxed as a grantor on this trust, all those assets are going to be brought back into your estate. So really, this is trying to force more people into, if you're going to put stuff in trust, it's going to be a separate taxpayer, and we're not going to let you play that game. Before this, so again, taxpayers could use grantor trusts to push assets out of their state. The controlling trust closely, that's not really the provision here. That's misdirecting. It's the grantor could still pay income tax generated on the trust or inside the trust. There's also going to be this new section 1062, which treats sales between grantor trusts and the deemed owner. So effectively it's a, sell from the right hand, meaning the grantor, to the left hand, which for income tax purposes, before they were the same person, you're going from the grantor to the grantor trust, they're treated the same. Those are going to be treated as third-party sales. So you're going to recognize gain. You're not going to recognize loss. And this is only going to be made to future trusts and future transfers. Again, there's a lot here. So kind of thinking through what we've got. Again, the grantor trust has been this alter ego for income tax purposes. So we were able to push assets into the trust that we're making the trade-off of, well, sure, we're going to sell this asset in. It's a different form of gift because we were planning on zero gift into the trust. And, Doug, yeah, I'm sorry. Good news and bad news. But here's what we're thinking about is this, this is a way that was there to kind of defer some of the income tax. What that income tax then does, well, before, when you pushed assets into the grantor trust, it kept whatever low basis. You weren't triggering the sale. Now we're triggering the sale. What you're also going to do is you're going to have the ability for those assets to get a basis step up on death. Obviously, early days, we don't know that this is real law yet, so who knows. The other thing to think about, there are swaps for assets. So again, they're talking about this new provision that will allow for sales to effectively be disregarded. Looks like swapping assets will also be treated this way. This was a common way to have grantor trusts be taxed as grantor trusts by just giving the grantor the ability to swap assets out. So why would we do this? Once somebody gets towards the end of their life, we look at them and say, well, look, they've got this cash in their hand. They've got these low basis assets in the trust. We're going to get a basis step up on death. We don't want to get the basis step up on cash because its basis is equal to its face value. So you swap the cash for the assets in the trust. The grantor dies owning the low basis asset. You get the basis step up to fair market value, and the cash inside the trust is available to either purchase the asset or do something else with it. So we've talked about estate taxation of grantor trust. Other thing to think about, insurance trusts are almost always going to be grantor trusts. The ability to use trust income for the payment of life insurance. Well, the idea was we want to put life insurance aside so that it can pay the estate tax bill. The problem is, if you own life insurance outright, the death benefit, not necessarily the cash value or even the premiums paid, subject to estate tax. So if you have a policy worth $1 million, that's subject to estate tax. 40%, if you're over the line, if you've got too much in assets, then 40% of that life insurance policy is going to be subject to estate tax. So instead of buying $1 million policy and getting effectively $1 million in benefits, you're buying a $4 million or you're buying a $1 million policy, and you're only going to get $600,000 after you pay the estate tax on it. So the existing trusts are going to be grandfathered, but future payment of insurance premiums by the insured will be considered additional contributions to the trust. So this is looking like there's going to be some sort of mix. You've got to prove that the trustee paid the premiums. Without knowing more, it's hard to say exactly what this looks like, but probably the gifts into the trust of cash will, trigger gift tax. You will have used up that amount to run down your lifetime credit. When you've got that inside, I would think that payments made by the trustee for premium amounts should not trigger this sort of inclusion that they've proposed. Who knows? We'll see. Grantor retained annuity trusts or grants. These are things where you put assets in trust. The grantor retains an annuity payment. So you put $1 million in, the grantor gets payments back from the trust for a few years. And then at the end of those annuity payments, the remaining assets go off to somebody else. When they do that, well, we've got to start thinking about what could this end up being. And the idea is we want to push the assets out. We want to try and make the annuity payment as low as possible so that we're gifting away as much as possible. The new way that this looks, it looks like, again, 2901 grats are basically no longer going to work. We'll have to see if this actually makes it through. Another trust, also known SLATs or spousal lifetime access trusts. So this is generally when you set up a trust for the benefit of your spouse and your descendants. Generally, when you name your spouse as a trust beneficiary, the results are going to be that you treat this trust as a grantor trust. Now, that's what's going to pull it back in. So it's going to be hard to create some sort of irrevocable trust for the benefit of your spouse without bringing all the assets back into estate taxation. It's going to be a lot harder to thread that needle. Slats were already something that I just didn't like mostly, and we'll see if this actually makes it through. Let's see, other things to think about. Obviously, a lot of the trust rules are going to get changed. We'll see what happens once they actually get something passed. So what else? Contribution limit on individual retirement plans. So basically, they're proposing that contributions to a Roth or traditional for taxable years, if an individual's IRA and defined contribution accounts exceed $10 million, they're going to be limited. Basically, once you've put enough away under this proposed section 138.301, they're going to say, look, you're not going to be able to put any more in there. We'll have to see what this looks like once it gets closer, but you'll see probably a lot of contributions to IRAs by high income earners before the end of the year. We're also going to see section 138.302, increasing the minimum required distributions for high income taxpayers with large retirement accounts. Again, if you've got too much in your IRAs, they're going to force more out. So once income is in an IRA, it grows tax-free. When it comes out, it's subject to income tax again. What they're doing here, they're just saying we're going to make it take more out. Other provisions to think about. Section 138.311. This is going to be addressing the backdoor Roth conversions. So there are a number of ways that you can get assets into a Roth. The problem has been that the contribution limit is for Roth IRAs in 2021, $125,000 to $140,000. Basically, it gets phased out as the income goes up. Once you get above 140 for a single taxpayer, you're not allowed to contribute to a Roth anymore. Now, there are what is known as a backdoor Roth strategy where you put assets into an IRA, then you convert it to a Roth. This backdoor strategy is going to get limited for folks making over $400,000, single or married taxpayers who are filing jointly with over $450,000. This is going to apply to distributions, transfers, contributions made after December 31. Now, oh golly, we've been going at this for half an hour. Things to think about, just kind of wrapping this up as what to think about. Right now, again, these are all proposals. We don't have finalized legislation. It's got to get out of not only committee, but also out of the House and then through the Senate. Some of these provisions are going to be effective as of the date of introduction or the date the legislation is passed. We won't know until we get further down the line. The trusts will probably still be they'll give everybody a chance from now through the end of the year to get those set up. So forecasting a holiday season, busy drafting new trusts while folks are getting this up and running. So with that in mind, thanks for hanging around and watching. There's a lot here. There's a lot more to come. Stay tuned. Thanks, y'all.